The FDIC was created in 1933. It was created as part of the Banking Act. A third of banks failed before this happened, and people's savings were wiped out because of the Depression and different banking panics, which is why they made the FDIC. They guarantee your bank accounts are covered. They're the failsafe if a bank will need to close. They receive no federal funds and are not funded by taxes. They just help maintain financial stability.
You can keep your Marxist ways, for it's only just a phase. Money, money, money makes the world go round.
Now that we've confirmed why I don't sing for a living, let's discuss the FDIC. The Federal Deposit Insurance Corporation is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. The FDIC insures deposits, examines and supervises financial institutions for safety, soundness, and consumer protection, makes large and complex financial institutions resolvable, and manages receivership. And as mentioned previously off-key, the FDIC was created as part of the 1933 Banking Act. Above is a summary of bullet points from this particular Banking Act. Feel free to pause and read. The Banking Act of 1935 made the FDIC a permanent agency of the government and provided permanent deposit insurance maintained at $5,000. In the 1933 Act, the amount was $2,500. The amount that it covers per account basically has increased over time. As of today, that amount is $250,000, which covers the vast majority of people in the US, unless you're a billionaire, but that's a whole thing. At a lot of banks and several institutions, you'll see things that says that it's insured by the FDIC. Well, let's look at the history of that. Without deposit insurance, bank depositors took the risk that their bank could run out of cash due to losses on its loans or an unexpected surge in withdrawals, leaving them with few options to recover their money. During the panics of 1893 and 1907, many banks filed bankruptcy due to bank runs. Both of the panics renewed discussion on deposit insurance. After 1907, 8 states established deposit insurance funds. Due to the lax regulation of banks and the widespread inability of banks to branch, small local unit banks, often with poor financial health, grew in numbers, especially in western and southern states. With the instability of banks, the Great Depression was no help. From 1921 to 1929, approximately 5,700 bank failures occurred, concentrated in rural areas. Nearly 10,000 failures occurred from 1929 to 1933, or more than one-third of all U.S. banks. A panic in February 1933 spread so rapidly that most state governments ordered the closure of all banks. As someone that had grandparents born in the 1920s that lived through several major events, they do remember the bank instability and had some trepidancy towards banks. The FDIC does a lot of stuff quietly in the background to make sure that it's business as usual. If you would like to see an example of how the FDIC trains to take over when a bank fails, I would check out the 3rd episode of The G Word with Anna Conover titled Money, of course. On a positive note, the president cannot pull funding from the FDIC because they have absolutely no control of it, and neither does Congress. The FDIC receives no funding from the federal budget. Instead, it assesses premiums on each member and accumulates them in a deposit insurance fund that it uses to pay its operating costs and the deposits of failed banks. Under the Dodd-Frank Act of 2010, the FDIC is required to fund the DIF to at least 1.35% of all insured deposits. In 2020, the amount of insured deposits was approximately $8.9 trillion, and therefore the fund requirement was $120 billion. What if there's a banking crisis? Well, during 2 banking crises, the savings and loan crisis of the 2008 financial crisis, the FDIC expanded its entire insurance fund. On these occasions, it met insurance obligations directly from operating cash or by borrowing through the Federal Financing Bank. Another option, which it has never used, is a direct line of credit with the Treasury on which it can borrow up to $100 billion. So if your bank has that sticker that says FDIC insured, that's a good thing. So let's hope nothing happens to the FDIC.